What do you make of what's going on, Mark?
Well, obviously, Japan can't let their currency go, no matter what they say about the fact that they're watching the market or not watching the market. But it is just too big an impact on the whole economy, and it's inflationary as well. So at some stage, they have to do something to reverse the yen. What we saw yesterday, quite possibly, was just the Bank of Japan checking rates with traders. It doesn't look as though it was a significant market intervention from the authorities. Because don't forget, when they did it in October, they literally battered the foreign exchange market into submission. The amount of money they spent in the market was so overwhelming, traders had no choice but to give in. You can see the reaction in the past 24 hours. Traders, they were hurt a little, but they've really come back already, and we're back above 149. We're not that far away from heading towards 150 again. So if the Japanese authorities want to, they're going to have to come in with a huge amount of intervention, maybe even more than they did last year, because actually the conditions have changed against them since they intervened in October last year. If anything, they keep on talking about the fundamentals. The yen should reflect the fundamentals. Well, the fundamentals favor the US even more now than they did the last time. Interest rate differentials are wider. The US economies are humming along at a very strong rate, and the money is flowing back towards the US dollar. Those things are working against Japan, and they don't also have the benefit of last time they had the help from China. It was about to come out of COVID zero. That was a supportive of the yuan. That is not happening this time around. If anything, Bank of Japan and the Ministry of Finance will have to try even harder if they want to fix the yen this time.
And we've been talking about these 10-year swaps in the JGB market as basically we're at 1% here right now. So, fixed income traders also are not really buying all these, what the BOJ has been saying about, these bond buying operations. This auction was actually, yesterday, was better than expected.
You can't have it both ways. The Bank of Japan seems to be doubling down on its easy policy, but at the same time, it can see global yields are rising all over the place, and the yen is extremely weak. You can't do, as you were saying earlier, there's a trilemma here. You can't fix everything. Something has to go. So eventually, if they decide that the yen is the bigger priority, which it probably is in the end, that is the one they will probably go for. That means that the yields will just have to rise anyway. And what the Bank of Japan doing as well in the market so far, is smoothing the market, but they're not really changing the direction of it. Even the traders can see that the buying of purchases of JGBs, again, is not an enormous amount. It's not the kind of amount that would really make traders sit back and say, wow, that's so big, I have to do something about it. It's just enough to smooth the market, make it a little bit easier. That's why largely traders are ignoring what's happening here. It's just giving them, actually, it's giving them a better chance to sell JGBs than they had yesterday. So the Bank of Japan and the Ministry of Finance have got to get together here and decide at which point is the yen needs to be saved. It's probably going to be a little bit higher than this, but when they do, it has to be huge.